So it's important to understand what direction the tide is going. In many different facets of life, markets is no different. And we've moved from a period of time, an extended period of time, multiple years, where the Fed has been swamping markets with liquidity. Governments have been sending checks literally to consumers. And in that environment, being long risk makes a lot of sense. All of that's beginning to shift and change. Interest rates are going up, fiscal stimulus is being withdrawn. And so from a portfolio perspective, early in the year, I sat down and went through name by name and just did a risk assessment to try and discern which names I felt were most at risk to a change in the economic backdrop, and make sure that I do my best to try and avoid significant impairments of capital, big declines in equity prices as a result of a change in the economic environment. As we moved through that time period, given the run-up in energy stocks, from a sector perspective, I have reduced my exposure to energy. We all hope that the current environment in Ukraine is transitory, that this war will end relatively soon, and that geopolitical risk is certainly embedded in crude oil prices and natural gas prices. And my hope, my anticipation is that that war will be resolved and that geopolitical risk premium will come out. And so energy has been a great place to be invested. We've definitely benefited from that as a firm for those invested in the waterfront equity and waterfront balance strategies. I just took the opportunity to shave off some of that overweight, and I invested it in areas of the market that are less sensitive to economic growth. Specifically, staples had been an overweight relative to the benchmark, which is the S&P 500. I added to that. Most recently added Kraft Heinz, a company you're probably very familiar with. And then I also went from an underweight position in utilities to an overweight position in the March time period. I added a company called the Southern Company, which is a utility in the southeastern portion of the US that has a positive regulatory environment and a growth kicker from a new nuclear power plant that hopefully will be coming online over the course of the next 18 months. And I'd say most recently, over the course of the last several weeks, we've seen, as Chris mentioned, a significant pullback in growth stocks. And so over the last couple of weeks, I spent a fair amount of time weeding through those names that have pulled back the 50, 60, 70% to try and discern if there's any of the baby being thrown out with the bathwater, to use that analogy, opportunities inside that group. Last week, I actually initiated a position in one of the stocks Chris highlighted, PayPal. I think it's a company that was massively a beneficiary of the growth in e-commerce as a result of the pandemic. Their growth is decelerating significantly. Their profitability, however, has been stable, and my expectation going forward is that competitively, their ability to outgrow e-commerce will prove durable, and their profitability will prove durable. It's a stock that used to trade at a dramatic premium to other stocks in the S&P 500. Today, it trades in line with an average company in the S&P 500, and I think its growth prospects and certainly its profitability is above average. And so that's what I do. I spend all my time trying to find opportunities like that, and my anticipation is, and my hope is that there will be more of those that I'll identify in the near future. But big picture, from a portfolio construction perspective, both for the balanced and the equity funds, I'm being very careful about trying to manage risk and ensure that my exposure to economic growth in particular isn't outsized, and really narrow my focus and make sure I'm trying to find quality companies that have above average profitability with drivers that enable that to continue into the future, that can thrive even in downturns. The equities may pull back, but generally in downturns, these kind of companies expand their competitive advantage. They survive. They not only survive, they get even better relative to peers that have more leverage on their balance sheet or competitive advantage that isn't sustainable. And so these kind of companies tend to take market share and come out on the other side of a recession if and when that comes in an even stronger standpoint. And so taking the opportunity that may come, or being ready to take the opportunity that may come in the event that those stocks pull back to a meaningful amount, is something that I'm incrementally very focused on.